Bruce, welcome back to Face.
Hey, it's great to
And
be here. Can you hear me okay?
yeah, do a lot of people call you Bruce Wyckoff?
It's been known to happen. Yeah,
You don't mind, do you?
it's not a bad thing.
Yeah, when people call me DJ Gann and, uh, Dale Livermore, no big deal. So,
It's a good thing. It's a good
yeah,
thing.
welcome back, Bruce. Do you want to share
Oh
your
my
screen?
gosh. Yeah, sure.
And I don't know if you have anything prepared or you just want me to wing it here with you. Okay, you do. All right, stocks
Oh,
march onward. All right.
I brought the kitchen sink.
All right.
I brought
So
everything.
you're a content king. So what's the cartoon saying? Wall Street, stock boom. Okay, beating the drum. I was going
This
to
is
ask
the.
you. Go ahead.
Please.
No, go ahead.
Oh, I was just going to say about this cartoon is it really speaks to the environment that we're in right now with the financial markets and the economy, because as we all know from a year ago, the COVID low, that the stock market just went on just a ramp.
Yeah.
And so this is our guy banging the drum. And this is what typically happens, is that you get a launch in the stock market, and then some number of quarters later, the economy starts to reflect the boom that's occurring in the stock market. And so in the last year, you've had a substandard growth in the economy, but you've had a screaming financial markets, and especially the stock market. And now you can see the wagon back there with all the people on it. That's the national prosperity. And we know in the next couple of quarters that we should see just booming GDP growth, and we're starting to see inflation coming back in and so on. This is really pretty typical of the way it happens, and it has consequences for how the financial markets trade.
Yeah. So could we have so maybe what we're going to do is the handoff to the real economy, and that's why people are buying like deep cyclicals and materials and all of those things. And some of the darlings that got us there begin to underperform. Bruce, is that kind of the
exact. I think how we could portray it is that we're going to be in a rotational market. So what happens is it, as the economy starts to mature into its growth phase, the stock market actually will start to show more of a capacity to have rotation within it. Doesn't mean stocks can't go up, but it does mean that they may go up at they're likely to go up at a lesser trajectory, and they'll go up. There'll be more winners and losers. And so, which is fun. I mean, this is the way the game works. And so we just have to really just brush off all our rotation tools and, be ready for that.
Could we have a 10 to 30% correction in the interim before the handoff between here, the market and the real economy?
We could, yeah. It's not uncommon to see a correction intervene. We don't have to have that. I think that the Fed's demonstrated that they're, the last thing they want is to have to fix a cyclical downturn. 10% is probably
the most,
the equivalent of market noise, where 30% would be, I think, really damaging. The thing that, gosh, Dale, it's like you saw my presentation. It's like I can't keep up with you. So I have just a bunch of different charts, but one of the charts,
because I was going to ask you, everyone, the different methods have different lines in the sand. And I'm one, kind of like, people are saying as long as we hold 3,700, we're okay. So I was wondering what your methodology would say that here the point and figures, beautiful work. I'm just going to let you explain it.
Sure. So this is a chart that I publish these charts up on a program I do on stockcharts.com called Power Charting. It's entirely free. You can either watch it live or you can watch it on YouTube. And so I brought these up to date, but one of the things that I've found very interesting here is, and of course in Wyckoff we use horizontal point and figure counting to give us price objectives. And here I'm actually using this point and figure technique, which is as old as markets are. So point and figure horizontal counting is a very old methodology, but it's incredibly powerful. And so here you can see that there's an accumulation phase that developed in interest rates back in 2020. And of course, this is all in preparation for this big booming economy that we're going to have, because we know that a booming economy demands money, and the cost of money, as we know, is interest rates. So I did this point and figure chart back at that time. I think that the date on this was January 4th, and it was just completing what appeared to be the accumulation phase. And so I had effectively 3 segments counted here. You can see also this distribution and redistribution count, both counted down into this interest rate low. But at that time, it looked as though interest rates were going to start to go up. And in fact, this is where they are now. They're right in the middle of the first objective range. And so this would be, in this range would be the area where we would expect, call it a pause. There are 2 higher objective ranges that are flagged here. One is like 2.14 up to 2.52%. That's the B range. And the C range goes as high as 3%. So now here's the cautionary tale here. This chart on the left is actually just a line chart of interest rates. This is 10-year yields. You can see what in fact actually happened, and I put a red line where we are now. And so here you can see, this was a slide I did a while back, but you can see that when interest rates started to go up, they just went vertical. And so here we are into that area. And so this is actually prices. I did the same work on horizontal counting on prices itself. And you can see this is where we are now. We're in this first objective range at around 130, 133 currently. And I suspect that we'll stabilize rates here. Now, what are the consequences of this? So the consequences, so here's the 10-year yields on top. Now we're looking at this is 1986, this is 1988. And so this is a period that looks an awful lot like what we just went through, which is, look at this accumulation area for interest rates.
Interesting.
So this has a family resemblance to the current situation. And then there was just a vertical launch in rates into the fall. Well, here is the, speaking of the fall, a pun, because this is the S&P 500 and this is the 87 crash.
Yeah, you know, the interesting analog. And what's interesting about it is now people are conditioned that higher interest rates are bad for tech. You know, it's all about yields, bad for gold.
Sure.
And if you look at the charts you're presenting right here, because I lived through this, rates, yields were going up, the dollar was under pressure, and the market kept going for quite some time, a term called disintermediation, until we got to a tipping point. And so it killed a lot of bears before the crash because they saw the outside markets. Go ahead.
No, what you're saying is spot on. And so here, this might be the initial lift. And here we are sideways, as we currently seem to be doing in the current market situation. Here's the difference between now and then. Interest rates were much, much higher back then. They went,
the base was 7%, right?
Sure. And here they are over 10.
Yeah.
And this is on the 10-year. And so interest rates were much higher, but also stock valuations were much more moderate. And so even though they were high on a relative basis, and it was a big uptrend in stock prices into August,
Right.
it was you had very high rates, and I think part of the issue here is not just how high rates are, and of course they're quite low now, but also how fast they go up. And so
Okay.
I believe that the speed at which rates go up can have a destabilizing effect. And so we have to be aware of that. So the thing that happened into August and October is that we had tremendous deterioration in the internals in the market. And I am not really seeing that happening yet. And so,
Right.
and it may not happen at all. And so that's the thing that I'd be looking for, is I'd be putting my tape reading
Like
hat on.
AD line. I mean, in
Yes,
Nasdaq,
yes, yes.
at new highs, we're not having confirmation with the advance decline, are we?
No, and those are
That's
the
the
things
only one, right?
yes, and
Or
that
is
could be part
Russell
of the
there too?
that could be part of the rotation,
Okay.
because the rotation I believe that the rotation is into the value and the more small cap segments of the market. So I'll
Right.
just show you here, just for so that you can see the current environment. You can see here's the base. Look at the family resemblance to that 86,
Yeah.
87, 88 period.
It's
And then
amazing.
it really is. And now you can see the very fast rate at which rates are going up. They've
Yeah.
gone into our first target zone. So we're just going to be patient with this, because as
What
we
kind?
saw, and you pointed out, the
Yeah.
stock market can still go higher
Right.
into the face of these rising rates. And you can see
Yeah.
this launch.
Yeah. It did for months. Um, and I was going to ask you about when you look at the parallels between the two markets, the fact that we have low rates is how people are going to rationalize. I mean, you talk about a big move to 3%, and people will still say then they'll rationalize it. They're still very historically low rates.
Yes, no
When
question.
instead of
Yes.
putting it into the reference, well,
Yeah.
they're low rates, but what kind of service on the debt?
Yes.
The size of the debt compared to what it
Yes.
was. So, um, yeah, I'm interested in what you're thinking here as well on the yields with your point and figure. Do you think we could have a pause and pull all the way back to the breakout about 1%, Bruce, or
I
not
believe
that
that
deep?
I believe that. So here's that chart we just looked at,
Right,
and here's where we are. And I
right.
believe, I
We just
just
got
my
a flag
sense
here.
about is
Yeah,
that what happens is, and this is a pretty wide area, but
yeah,
also notice this is congestion over here on the way down.
right.
And so here we are. I believe that we could see something akin to this over
Okay,
here, and it could go for months and months. And
okay.
I believe that the stock market, financial markets would be happy with just a stable, staid yield environment.
And so with the Fed.
And so would the Fed. So I think that they'd be happy with it in this area. And as in a quiet interest rate environment, I think would keep the market happy too, generally
Okay,
stock
so
prices.
but if this is just the first wave out of a major turn, the Fed isn't going to be happy when we start getting to some of your B and C targets. What do you think they could
Agreed.
do? Because people are going to say, well, come on, Fed, you said you weren't going to let rates go up. Who wins the battle? Back then in '87, it was the bond vigilantes that won until the market cratered. Who wins
Yeah,
now?
and
Jay Powell or the bond vigilantes?
well, I think that the Fed's bias is going to be to and I've been doing this for gosh over 40 years, and so I'm really an old guy and I've seen a lot of stuff. But the back in the uh, prior days of high inflation, high interest rates, the Fed pretty much did everything they could to ignore the inflation data. and just go on with their policy decisions, which was to sort of be profligate, print money, and keep the economy going. So what happens is the Fed becomes focused on keeping the economy bumping along, and they're willing to put up with a certain amount of inflation to make that happen. And
So
so
it's
this
like
is the thing.
yeah, we're almost in the opposite situation.
Mm-hmm.
Back then, they wanted to, fight inflation, and they weren't bashful about doing it. And now the Fed wants to cause inflation.
Well, I'm thinking actually the Arthur Burns 60s and 70s, at the
Yeah.
Fed.
Oh, okay. Yeah.
Yeah, and then when Volcker came along,
And crushed
his
it.
whole approach was to just crush really high inflation rates, and we're nowhere near that. So I
Yeah.
think that the Fed's willing to put up with a certain amount of inflation and maintain their policy stance that they have now, and I believe that they could do that for a long, long time. So uh, that's kind of my sense about how this is going to go. And
Okay.
so we are, and here's the big call, is that after about 30 plus years of falling interest rates, going back to the Volcker era,
Yeah.
is that now we're in a situation where we could actually have secular rising interest rates, where this could have been a major low here. We
Yeah.
could be looking at just interest rates rising and then consolidating, rising, consolidating for a very long time.
So we may
And
have launched a bear market in bonds finally that has been predicted for the last 10 years.
yeah,
That took several stabs at historic lows, sometimes just equaling them and then finally taking them out. But how are you believers, Bruce, that, the biggest markets out there, bigger than the stock market, bigger than the bond market, is the currency market? Is the dollar the fulcrum of what's going to be coming? And is the dollar going to be the sacrificial lamb along with bonds to keep things going? What do you think?
well, it's a really complicated question, and you can't always correlate
Yeah.
currencies to what's going on in the real economy. But I do believe that if our economy is the best, one of the best economies out there, and our interest rates are at a level where we're competitive, I believe that the dollar could continue to find a bid. And
Okay.
here's a chart. Now, I'm not a currency person. I apologize for that, because I know many of your people are. But this is a big trend channel, a couple of them, that goes back to 2014. And I believe this was at the beginning of January. I showed this as sort of my look ahead at the year. But
Yeah.
here was the dollar. This is just UUP dropping
Right.
down to the bottom of this channel area.
Right.
And also I had point and figure counts that were fulfilled. This was a distribution count up here. I could probably find that chart. I have it in the stack somewhere. But down we went to this green channel line, and sure enough, we have rallied off of that for the last quarter. And so you can
Okay.
see here that there's been a pretty good rally in the dollar, and also this is coinciding with those rising interest rates. And
Okay. Yeah.
so I believe that rising interest rates could be attractive to the dollar. And now this is a very old chart, December 30th,
Okay.
but here's the distribution count that I took at that time. And you can see that there was a count fulfilled down to this 24 level into the area of that trend line. And
Yeah.
now there's a bigger lower count that goes down to the 2013 area. And so there is the potential for lower prices in the dollar. My sense is that may have to come. See, that's this whole area up here. And you could
Hmm.
rally further before turning this back down and going. And here's the 20 around the area of the lower count, which is this very long-term support line. So
Okay.
there
Well,
is,
that would be another parallel with 87 because the dollar was declining during that. I think maybe that was that around. Did we have the Plaza Accord around then?
gosh, you're better on these things
Yeah,
than
it's
I
like
am.
Jim Baker, I think was
Hmm.
Treasury Secretary. But the dollar was falling, yields were rising, and the market kept going until it hit a tipping point. But
I do
that was
remember,
part of the mix of the 87 crash was
yes.
a deep dollar decline with rising yields, which is, kind of the opposite of, what's happening now is the dollar likes higher yields and gold doesn't like higher yields, but don't marry that correlation because you could have higher yields and the real rates, the nominal rates are different than the real rate. And if the inflation rate is above the nominal rate, you could still have um, gold go up while yields are going up,
And this
right?
is exactly why, Wyckoff is a tape reading. We call
Yeah,
it a tape reading methodology where
yeah,
we basically look for the evidence in the way that these markets are trading for our entry and exit points and also point and figure for objective ranges and so on. And so this is a chart that I started to follow. This goes back to your earlier question, actually, but this is a chart that I started to follow back middle of last year. This downward line, this is a relative strength ratio, really, between the VTV Vanguard Value ETF and the QQQ, which
yeah,
is really large cap growth. And just to make the point, and this chart really doesn't even go back to the beginning of it, the theme of the last 10 years has
yeah,
been that growth has been really dominant. Now, I've gone back and I've documented, these were all periods in my career. The early 80s was the first growth boom that I was personally involved in, and
yeah,
was early 80s.
yeah.
IPO boom.
The low was in the stock market. I think it was 760 in the Dow in 1982. And I think that was an August low that we had for the launch of this generational bull market. But it was
Uh,
1982, I believe,
that
August.
was the very early in my career in the financial industry. And
Yeah,
so at that time, anybody that got involved in stocks was considered to be just like a nut. It's
right,
like, what are you
right.
doing? Real estate's where the action is.
Yeah.
And here I am getting involved in the stock market, which I loved. I mean, I had studied in graduate school, and then here we were actually in the early stages of a really booming growth phase,
All right. What
which
was your
ended.
first job? What was your first job? Did you go work for a wirehouse at any time, Bruce?
Oh, that's where I started.
Okay.
I was I started at Dean Witter as a retail
Okay.
stockbroker,
Okay.
and it was the best kind of training I could have had. And I had these remarkable mentors that helped me get my career started, and really taught me how to be an institutional broker.
I
And
was a runner on the floor and out trade clerk for Dean Witter on the CME.
oh, that's
Yeah,
awesome.
and
Yeah.
what was great about Dean Witter is they put him inside of Sears, so you could go buy IBM and a washer and dryer at the same time.
Stocks and socks.
Yeah, that's right.
that
So
that whole that whole thing started around the same time that I showed up at Dean Witter, and Dean
yeah,
Witter was a fine company, and
yeah, it was.
I loved working there, and it was a terrific place for me to be to start my career. But then I went over, as we say in the industry, I crossed the street, became a portfolio manager, and started to manage uh, large portfolios, pension funds, retirement accounts, and things like that. And so
You know,
that was my whole career, really.
all right, I want to know what you think of this. We have a very insightful audience, and Sanse is saying one dissimilarity is back in 1987, there was no cryptocurrency. or strong adversary like the euro as opportunistic challenges, which U.S. financial market is facing now. What do you think?
Well, I wouldn't disagree with that. I do think that there's money is fungible. It really moves around all over the world now. Currency markets are a lot more. I mean, there was definitely a lot of trading in a lot of areas. Commodity markets had a huge following back in those days, and
Yeah.
so
And
things
the
are certainly.
Deutschmark was around. It was as much of a competitor to the dollar as the
Absolutely.
euro because it was the strongest part of Europe. In fact, you
Yes.
could say the euro is mainly Germany now too.
Well, and let's not forget that in Japan was having a bull market,
Oh
an
yeah,
epic bull market for the ages
yeah,
that went right into the end of the decade of the 80s.
yeah. 89. Yeah,
And
and
so
I
that
think
was,
we finally just surpassed that high. Like
yes, I think that, I mean, if you can imagine that many years
32
ago.
years later.
Yeah.
Took a
So
while to break even if you bought the top.
I actually know people that did that very thing,
Yeah,
uh, and advised against it, but that
yeah.
I actually could tell you stories, which I'm not going to do.
Okay.
So, but here is this theme that we're in now, and being a Wyckoffean, you can see this downward line,
Yeah,
which I like to try to visualize these phenomena on the charts because I'm a total chart guy, and you can see when the line is dropping that growth is outperforming.
right.
When the line is rising, value's outperforming. And we go through, as we all know, long periods of time. Stocks are like fashions. The fashion has been growth for the last
Right.
10 years. And now something interesting is happening here where we've had a classic. Wyckoff has a unique way of drawing
It
trend
looks like the
lines and
yield chart.
channels. Yes. And so, well, that's Wyckoff, right?
Yeah,
So it's the whole idea of how do you identify these accumulation structures and distribution structures. And so here, look, you can see the throw over here. This is a big, beautiful distribution
yeah,
structure in 2016 for value.
yeah,
And then downward we go again. So here's another one. And so in this particular case, here we are, we can see this accumulation area and a turn up from an oversold condition because we fell out of the channel on a
yeah.
climactic surge after a
Right.
long decline, which is a classic
Classic.
bear market
Yeah,
conclusion. And
yeah,
so here is a close up. Now I'm looking at a slightly different ratio, same story, and that is this is the Russell
yeah,
2000, and this is the Russell 2000, and here is the accumulation area. So you can see here's
yeah,
this what we call preliminary support. Here's the climactic surge, two climactic lows, automatic rally, and then
yeah,
here's our accumulation area, which looks an awful lot like uh, the yield chart.
yeah,
So here at the conclusion is a spring and a test and the beginning of an important new uptrend. And so here's our uptrend. Here's the throw over. I apologize for all these trend lines, but I put all the big long-term 10-year historic
Could I
trend
get
lines
a
in here.
quick question in and then we have to wrap it? Do you have a point and figure chart? Forex Gals asking for a point and figure chart on the S&P and your opinion of it. I know there's probably just no reversals in sight. We're making new highs. So do you have anything like that? Do you have
Well,
an S&P? Go ahead. All
here
right.
is this is a chart that I actually showed you at the beginning of the year when we last met. And
Okay.
at that time, and this is actually the chart November, and you could see here that we were in the range of 3,500. Well, look
Yeah.
where we are. We're
Yeah.
up. This is the COVID accumulation area, and we are up here within 20 S&P points
Yeah.
of the top of this
4160.
range. That doesn't
Wow.
mean that the market has to go down, but
No, it's just a target.
it could very well mean that the market has to reaccumulate for another move. Here is a chart of the Nasdaq 100. This is the E-mini futures. My teaching partner, Roman, put this chart together, and you can see here, this count line is around 7,200, and this count line is around 11.6. It's a reaccumulation count. And this chart is actually from the beginning of the year. And I think we may have looked at this chart when we got together. But now look where we are, 13,975, but we still have further to go. And so that is a that's a consideration. And then let's see, I think I did another chart. This chart is a intraday point and figure. I love to do those. This is 30-minute data. And this is the area. Now I'm looking at a daily chart over here. You can see this is, look at how much this on a small scale looks like the yield chart we first looked at.
Right.
And so downward slope to it, and then it just completes its accumulation, starts to go. Well, at the time that this was putting in its, what we call a last point of support, we took account 2 phases. And so we have 349, 360, and we have 403, 413 for the whole accumulation area on this 30-minute data. And so that does, and this chart is up to date, which is I think around 340, 60, and right here, 340, 60. So we have still upside potential, and the growth phase is now kicking off and doing quite well. So now let me just show you this one chart. I know we're running out of time, so I'll hurry this. But this is the percent of Nasdaq stocks on the stock exchange, on the Nasdaq Composite, that are above their 50-day moving average. So it's a breadth indicator. And so here, this is the same area that we just counted on the Qs right here. And notice this. Now, typically when this line is rising, it shows that more and more stocks are getting above their 50-day moving average in the composite. Well, look what's happening here. It's not rallying, which says to me that at least so far, now I believe this line will start to rally, but that it's lagging badly, which is very unusual. I believe that the rally that we're getting in the Nasdaq 100 is very narrow, and it's the large FANG type, not just the FANGs, but all the, the leading large cap growth names are what's driving this rally that we're in. So these are the little hints and clues we look for evidence of that rotational nature to things.
Okay, so the teeth are falling out, the fangs are falling out, may need some false teeth. So okay, great. You're such a pro at this. I was going to ask you to do this. So this is where you could find Bruce. And learn more from Bruce, and go ahead.
Roman, my teaching partner at Golden Gate University in San Francisco, when we were teaching now, he teaches an online course of the material that we taught in the classroom. He's a wonderful teacher. He's got a complimentary session coming on 4/19. And then also we do a weekly Wyckoff market discussion where we cover these markets just as you and I have done today. And we're doing a complimentary session on April 21st. Welcome to join in, and just go to wyckoffanalytix.com to learn more. So
thank you, my trading warrior brother.
Oh my gosh.
Veteran trading warrior brother. You and I kind of go back to the same time frames. And there's our fraternity brothers.
Yes, exactly. And so here's that whole cyclicality of markets, accumulation, markup, distribution, and this is our it's just, this is the whole idea about the tape reading of these markets to determine what tactics to follow, and it's just so much fun.
Great interview, Bruce, and I'm happy to have you now in the regular rotation.
Oh my gosh! Well, thank
you. And I'm going to get in touch with you after this. I want to remind everyone that the Morning Edge starts in 8 minutes. But Bruce, I want to thank you most of all for coming here and sharing your elite. I think it's elite work. So
Well, it's
thank you.
great to be with your people and with you, and I look forward to it in the future.
Okay, buddy. So good hunting. May you win in every tick. May all your point and figure charts be winning tic-tac-toe games.
Oh my gosh. Well,
All right.
there it is. It's what I do.
All right, Bruce.
Thank you, dear
Bruce,
friend.
all right, Bruce Fraser, everyone, and you could find him on Twitter, and you could communicate with him or go right to his website. Check out his course, Bruce Fraser at RD Wyckoff. Thank you, buddy.
Take care, everyone. See you next time.
Okay, so that's a wrap, everyone. We'll see you tomorrow. Morning Edge in 7 minutes. Adios. And don't just count your X's and O's, count your blessings.